everyone, now, while we wait for a few more minutes for people to join, if you've got any questions on down rounds or anything related to that, please pop them in the chat. We'd love to know your questions so that we can give you all the help that you need on this call. We may answer. And by the way, as we're talking, if you do have any questions, pop them in the chat, and we'll turn to the chat periodically to cover them. All right. And that looks like a suitably grey day for you there, Rufus. So definitely no problem with too much backlight. So
our plant's not looking very happy. There's not enough sunlight.
The plant is definitely not looking perky. All right. All right, we'll give a moment more, and let me just pop a question thing in there. All right, let's get started. So, hello everyone. Today we're talking about down rounds. Now, when you start a company, your goal, of course, is to grow the company. So you raise money, and ideally, every 12 to 18 months, you're going to have a new round. You're going to raise 3 to 5 times the amount of the last round at 3 to 5 times the valuation of the last round. And I think the magic formula, if you can achieve it, is your goal is perhaps over 3 funding rounds, each time raising 3 to 5 times the last round at 3 to 5 times the valuation, such that after the 3rd round, you either are profitable and don't need to raise again, or you're ready to exit and you find a buyer and have a nice exit, and everyone makes, for the investors, a good return on their investment. And for the founders, you get something from all your hard work and being underpaid for many years. But of course, things always don't go to plan. Sometimes they go slightly less to plan. Sometimes they go way off. And particularly these days where interest rates are higher, that means investors need more of a return on their investment to balance otherwise just keeping the money in the bank. So valuations have been down for the last few years. Fundraising is harder, there's less money potentially available, and that means if you are unable to raise at the valuation you want, what to do next. So today we're talking about the down round. And down rounds, I think broadly, you can put them in 3 categories. There's the not an up round. So we raised a few years back at, 3 million valuation. We're now raising, we can't raise it much more than 3, maybe it's like 2.5. Not a huge issue, but not an up round. That's class 1. Class 2 is quite a discount. Our last round was way too effervescent. We raised it at 10 million. No one's interested in that price. We need to raise it 5 million to tempt people. We were just crazy enthusiastic. So I'll put that as the substantial discount. And the 3rd category is, the sort of total wipeout, which was we raised it at 10 million, and actually we're going to now raise it at £300,000 valuation. And this is often called last man standing. So with me today to discuss all of this is Rufus. Rufus, over to you to introduce yourself.
Hi there. Yeah, thanks for that, Anthony. And hi, everybody. I'll just give a very brief overview of what we do, and you'll very quickly see why we are well placed to see what's happening in the market. So effectively, as an angel investor, it's a portfolio approach. You invest in multiple companies, and you only need the top few to do well in order to show a decent return. And that's because of the incredible tax breaks, not least on the tax-free upside, but also on the loss relief on the downside. But a lot of companies end up in this locked middle where they don't fail, but they just underperform. And there's nothing you can do about that situation. And so we've created a mechanism by which angel investors can choose to exit those companies at today's fair value. So in the examples that Anthony was giving, if you invested at, at 3 million and it's now 50% down, or if it's 90% down or even 99% down, if it's not worthless and trending to zero, you can't do anything about it. And so we have created a way for people to effectively crystallize an exit and take their losses. And it's a massive, massive problem. But as a result, we are clearly seeing a lot of investors come to us and say, I invested in this company, the hope and expectation didn't materialize. It's come down in value. Either I think it's worth, X and I want to get rid of it, but there's no market, or they've just done a down round and I don't know what to do. And we're there and we see that all day long. Sometimes founders come to us because obviously it's a difficult situation. If you haven't performed, then you may have some investors on your cap table that are causing a storm and shouting and saying, get me out of here. I don't want to be on this cap table anymore. And it's very difficult as a founder because there aren't any ways to do that. So that's why we built Plan D. As Anthony said, we're seeing a lot of these deeply discounted rights issues, it's even down to a sort of even a £10,000 pre-money valuation. It's completely mind-blowing. A lot of founders don't even know that this is a mechanism by which they can reset. So that's a bit of background.
All right. So over this call, we're going to go through the things that if you're a founder and you're encountering, potential for a down round, hopefully all the things that would come to mind for you. From, is this legal? What can my investors do? Can my investors fire me? How do I keep them happy? Can they be unhappy? What do I do next? So the first thing is to say there's no shame or embarrassment in a down round. The term down round sounds like a downer, but I think of it as a failure to be an upper in a sense. So, you made a bet when you started the company that things would go in a certain direction. And if they're not, it's a correction reset, and there's nothing to be embarrassed about. Your investors, depending on the investor, experienced investors know that not all of the investments take off. In fact, as Rufus said, for a VC, they understand, at least astute ones, that their investments obey a power law, which means if they invest in 10 companies, 5 of those will lose money or return roughly their investment. 2 or 3 of them will return maybe 2 or 3x their investment, and 1 or 2 of them will return 20 or 50x their investment. So when they are investing, they're playing a game of roulette that each of theirs will be like number 26 red and return 26x their investment. But for you, you could be anywhere on the spectrum. So if it turns out that you need to do a down round, for some investors, particularly naive ones or often ironically friends and family, for them, they're not serial investors, and for them it's a loss, at least on paper, and they may be quite upset. For astute investors, it's just that poker game and that one's not performing. So starting that is really important. The next thing is to understand why it's a down round. And one reason is you were just too exuberant in your first round. And that's, I think, something I see most frequently, where the first round or the last round was a crowdfunding round. So VCs will normally be quite pushy on the valuation. They'll look at your revenue, they'll look at multiples, they'll look at what's market, they're going to look for them getting diluted 3 more times before an exit and then work out, will they still make money? And so they'll push for a low valuation. But crowd investors putting in a few £100, firstly, are naive, and secondly, don't know how to measure valuation. And so often crowd rounds are far too high initially. And then you launch the product, realize you don't have much investment, and it gets reset, or you're now looking for more money and moving from crowd to VC, and there's a big reset. And that's sometimes in the category 1, a little bit, not an up round, or category 2, quite a lot of a down round. So the next thing to think about is what legal rights do the investors have? So let's say hypothetically your last round was at a 5 million valuation, and now things are not good. You've gone to investors. And actually now let me turn to you, Rufus. So let's go through each of these cases, which is you're looking to raise, your last round was, let's say, 5 million. You're now looking to raise at 10 million, and you're getting blank stares and no replies. Take us through the cascading set of things that you might want to do and you've seen founders do.
I think the first thing to say is that the market has never been tougher to raise. I mean, we're coming off the back of 2021, crazy money being thrown around at massive valuations, and the fallout's happening now. And so a lot of angel investors are having to allocate money that they would otherwise have liked to have put to new deals, and they're having to put them in to save current deals. And so as a founder, you have to say to yourself, what represents fair value today? And if I last raised 2-3 years ago, promising to be doing 5 million turnover now, and I'm actually doing one, how can I get away with even doing a flat round? So you're starting off already with on the back foot. And I think one of the keys for founders is to figure out how early to start the conversation. When things aren't going according to plan, it's easy to bury your head in the sand. But the reality is that the closer you are to your investors, the more likely they are to dip their hands in their pocket and help you out. But I've seen some investors that start off saying, okay, ideally we were going to do a Series A round, but around now for 3 or 4 million, but actually that's not realistic. Maybe we need 500,000. And so they go out and say, look, we'll do it at a flat. But clearly, if they've missed their numbers by that much, most of the current investors are astute enough to say, I'm not really willing to pay that. So then they say, well, what about a 20 discount? What about a 50 discount? And at this stage, you've kind of lost credibility. So you got to kind of read the room and figure out what represents fair value. And that's really, really tough. And I think the key is to start having conversations with some of your key investors that are likely to stand up and put their hand up and say, I will do this. And actually, before you reach out to everybody, get some kind of indications as to whether you're going to be one of those ones at a 20 or 50 or even a 90% discount or more, and then go out and start reaching out to the wider network and see what you can do.
Okay, so I think one of the challenges that you alluded to there is you can see things not going well, right? You've on your business plan, you said by the end of year 2 you'll be doing 5 million a year revenue or whatever, and actually you're still working on the product. It's barely launched. There's no users. There's no revenue yet. You're way off. So, and you've got, 12 months cash left, 6 months cash left. And so the question is, at what point do you now look to raise? And of course, the closer you are to running out of cash, the fewer choices you have available. And this is a really important point to note. I mean, not directly related to a down round, but if you've got 6 months of cash left and you halve your burn rate, which often means firing off the team, you buy yourself another 6 months. If you had 2 months of cash left, you buy yourself another 2 months. Plus, of course, with termination and so on, you're going to basically run out of money. So what you want to do is you want to be playing a much longer estimation game. And if you're getting close to 3 months and you still haven't made massive changes to your burn rate, then you are definitely, not in a position where you can sell your business. And you're definitely in a position where investors are less likely to want to put money in because they see it's about to, run out. If they do, it's going to be at the hugely discounted last man standing. So looking ahead to see what's happening. Are you getting short on runway, which is probably 6 months or less? You might argue it's even 9 months or less, and start putting in play the ways to mitigate that. So now let's go through. I think there are 3 strategies for fundraising before we look to alternates. So one of them is the big round. Number 2 is the top-up round. And number 3 is the seed fast or convertible note, which defers the valuation discussion till later. So Rufus, your thoughts on each of those strategies and which ones you might want to look at and fall back to if that doesn't work?
I think they're all, useful in the right circumstance. And I think that as a founder, you need to have the right people around you. And that doesn't just mean your fellow directors and founders. It's also, your legal advisors and so on. And obviously, without plugging it, SeedLegals, you can ask them and they'll be able to tell you what they think is suitable. But I think that it all depends on where you're at as to how much you need, whether, and again, coming back to the kind of the one or two people that are likely to stand up and be happy to lead the round. They often tend to lead the terms as well, and so I think that's probably one of the biggest takeaways.
Okay. All right. So let's go through probably the cascading thought process that most people would go through. So let's say your last round, you raised £1 million at a 5 million valuation. And your goal was you're going to raise your next round, you're going to raise 3 million at a 15 million valuation. But you're not on the course for your business plan. Investors are looking at you strangely at that valuation. So plan A is probably of 3 mil at a 15 mil valuation is probably off the table. Plan B is, okay, we didn't need 3 million, but if we had another million, that would be awesome. So we're going to do the top up round, and you might use instant investment, and you might top up, and you might say, okay, guys, we're not ready for our new round. We're going to top up the last round, and we're going to go for a slightly higher valuation potentially in the last round. So let's say it was 5 mil before, maybe we'll do 5 or 6, maybe it has to be a bit less, but we'll get to the less in a moment. So that's plan B. And plan C is actually, we don't want to set a valuation because either we can't agree it, or it's lower than we would like it to be, or it's bad optics because we hope we're going to pull through this and be able to do a new round fairly soon. And we don't want to have just done a round moments ago at a low valuation and then jump back high. And there, the answer is a seed fast, which says, or a convertible note saying, I'll give you money now, and it will convert into shares later at the valuation of your next round. And of course, you hope that that next round is going to be at a higher valuation. If it turns out to be a much lower valuation, well, we're going to get to that in a minute. So let's jump onto now the legal permissions that you need. And, when you do a funding round, you always need shareholder approval for issuing more shares. That's in companies law. And you normally need 75% approval for issuing shares and waiving preemption. And the founders usually have pretty much that, or with a couple of other investors or shareholders, can get to that. So there's often, in early stage rounds, maybe 50% of the time, there's an additional thing called investor consent. And if you have a VC in your last round, they probably ask for investor consent. And this means if you want to issue more shares, as in have a funding round, you need the consent of your investors, or 50% majority by the number of shares they hold. So you actually need to get the okay from your investors, and your board needs to vote as well to do a funding round. And the question then is, can your investors hold back? And you would think that the investors may be unhappy, but are unlikely to say you can't raise more, because the alternative is the company's going to run out of money. They'll lose everything. But you sometimes do get these shitty investors that would prefer to just cut their loss and the company goes out of business rather than doing a down round. So Rufus, what have you seen in that space, and any thoughts on that?
Yes, I mean, absolutely. There's often a situation where a company might end up in, where the company is an okay proposition for the founder, but not for the investors, and it's turned into a traditional kind of zombie type business, and that's kind of okay for the founder if they've built a business that's making $1 million a year and they're taking a salary and they've got an office and a few people, but it's not got the growth prospects that take it into a venture scale business. Then as an investor, that's a horrible place to be. And often investors would rather just take their losses. And, as I said, until Plan D came along, you weren't able to do that. But, thankfully now, both as a founder or an investor, there is that choice that you can take your losses and move on. But it's not a great place to be. And I think that there's just so much money tied up by investors in these kind of underperforming companies that needs to be recycled into new deals. And one of the sort of mildly interesting things about EIS, which not a lot of people know about, is that they are taken on a first in, first out basis on exit. So it's worth noting as a founder that there is a mechanism by which, if you're doing a wipeout round, some of your investors can sell their old shares and potentially either have invested or invest in the future in a round at a much lower price. And that might be financially astute for them to do that. Obviously, everyone needs to take their own advice and stuff, but that's something that not a lot of people know about.
Right, so let's actually dive into that. So just before we do, So the first thing for everyone contemplating a down round is, can my investors prevent me doing this? Do I have any legal obligations? And in particular, do I need to top them up? So some investors will be going, oh my God, you can't do this. You have to give me more shares to top me up. And the answer is you actually just look in your last shareholders agreement or articles to see. And if they have anti-dilution provisions, then you need to top them up potentially. And if they don't, then you don't. So in particular, if anyone got SEIS or EIS, one of the advantages of the scheme to the investors is the tax deduction, and the advantage of the scheme to you is the investors have to get ordinary shares and can't get anti-dilution. So what is anti-dilution? Anti-dilution says, from the perspective of an investor, you coming to them and saying, I've built this AI prototype, it's going to change everything. I'm raising money at a 5 million valuation. And they go, have you built anything? You go, no. Do you have any revenue? No. So the investor goes, I will buy into your insane 5 million valuation, unsupported by any facts so far, but I would anti-dilution shares. And that means if your next round is at a lower valuation, you're going to top up my shareholding as if this round was at that lower valuation. So it's actually a fairly sensible risk mitigation for the investor, because they're saying, all right, I'll go for your valuation. But if it turns out when you open the box, so to speak, and launch and there's no revenue, or it takes longer, then we're going to pretend that the last round was at the lower valuation. So if you have an investor with preference shares with anti-dilution and you raise at a lower valuation than the last round, you have to top them up. What does topping them up mean? It means giving them more shares. That means diluting all the existing shareholders because you're making more shares. And if an investor has anti-dilution shares and your next round is a much lower valuation, that's going to be potentially quite a wipeout. You may have to allocate them huge numbers of shares and massively dilute yourself. Hopefully it's only a small amount. And typically it'll only be VCs who are investing and getting preference shares that will have anti-dilution, but it's something to keep in mind. The usual use case for early stage UK startups is their investors will have SEIS and EIS, will not have any anti-dilution provisions. And so if you do a down round, particularly if they're early investors and they don't have investor consent rights, then they have no legal way of preventing you doing it, and you don't need to top them up at all. So it's really a conversation about minimizing unhappiness rather than needing to deal with any legal things. And the minimizing unhappiness is all about explaining SEIS and EIS, loss relief, and so on. So let's now jump to that.
One other thing, pro rata, I think is important to mention there, because that's one of the other mechanisms that virtually all shareholders will have, is that if there is a wipeout round happening, obviously sometimes there's loan conversions which further dilutes people and anti-dilution, but they should have the right to maintain their pro rata in the round, and that's sort of big decision for them to either throw more money at it or not, as the case may be.
That's a great point. So let me explain that. So, you have in company law in the UK preemption rights. This means if the company issues more shares, you can buy more shares yourself. You have the right to keep your same percent equity, and you buy more shares at whatever the price per share is in the new round. So let's say your last round was at a 10 million valuation, and you now need to raise at a 5 million valuation. You can go to your existing shareholders. You found one investor who'll come in at 5, and you can say to all your existing shareholders, you've got the right to invest more at a 5 mil valuation. Of course, they might tell you to get lost because they are losing money, or they might say, actually, I'm going to get substantially diluted. I thought it was a good deal at 10. It's a bargain at 5 because I think you're going to be back again. And of course, one of the reasons that you might need cash, it could be the business really doesn't have any immediate short-term likelihood of that success, and you're prolonging things, or it might mean there's just a temporary blip. You want to expand in a new market, you needed money, you've got a big contract that's about to happen, it's not payoff yet, but you can't raise at a higher valuation. But actually, once you've got this cash that you really need, then you're going to get to the next step. And so, you're going to look to sell the investors, of course, as far as you can, that this cash will get you to the next step. So let's talk about the SEIS and EIS loss relief. So I've had an instance of an investor that's preferred the company to go out of business rather than sell so that they can get their SEIS loss relief. So Rufus, tell me, what you see is the advantage or disadvantage from the investor side with SEIS, and how you might guide the investors to get to the outcome that you'd like.
So I think this comes to the point of locked-in capital, and if you've invested in a company, and every company sort of raises money, with a valuation that bakes in hope and expectation. After all, early stage is about painting a picture of the future that you hope is going to materialize. But if it doesn't, then your investment is worth less than you paid for it. And if you genuinely think that the company has got no future prospects, then unless they've actually done a price round which actually tells you, yes, your 10 grand investment is now worth 500 quid, and even so, you can't do anything with it. And so at that point, you're just stuck. And so your 10 grand investment that you may have taken EIS up front of 30%, 7 grand in cost is just worth 500 quid, but you can't do anything with it. No one would buy it, because if anyone wants to buy shares in that company, they'd want to buy a primary so that the cash goes into the company, not a secondary where the cash goes into the hands of a disaffected investor that just wants to take their losses and move on. And so you're stuck. And there are literally thousands of companies like this where investors do want to take their losses, but they don't know how to. And effectively how we do it is we have a fund that will acquire those shares at today's fair value on an exchange of shares basis. So today you've got, in the example, your 10 grand investment's worth 500 quid that you can't do anything with. You would now swap that investment into the fund, which is diversified across other deals, and you'd have £500 worth of shares in the fund tomorrow, but it would have crystallized a £6,500 loss, which you can now offset against income or capital gains. That's the beauty of the EIS and SEIS, is that you can offset your losses at the higher marginal rate of income, not just capital gains. But you can only take those losses and use them if you actually crystallize a loss. And that only happens if you sell your shares, or if the company goes under, or if it gets bought.
Okay, and that's your company, Plan D. And I must say, when I said Plan A is a big round, Plan B is a smaller round, Plan C is raised with seed fast or convertible. Then Plan D. I didn't plan that. So, all right. So let's talk about unhappy investors and how to proceed, and giving them a potential out to say, unfortunately, you're going to lose money on this, but you can swap your shares for shares in a fund that will hopefully perform better. And then you're off my cap table and you're not making my life difficult with ongoing things. So let's put now investors, when you're doing a down round, maybe into 3 categories. One, the understanding ones. These are usually people who've been around, shit, this is a loss in my investment. It happens, they put it in their spreadsheet and this one's down, and I'm here to support you when times are good or bad. And that's the investor that you really love. The second class is one which is really being annoying, that you've lost money and so on. And, you explain, the bank lends money because there's a 90x% chance that they're going to get their money back with some interest. But in startups, the numbers are different. It's we wouldn't call it a betting game, but your goal is to try and give the investor a 10x return on investment. But not all of those are going to work out, and you've done everything you can. You really need their help to get to the next step, hopefully make it a success, and hopefully that you can manage them so that they're not too painful. Then there's the third class, which is an interesting one, which is what I've called the last man standing. So last man standing is an investor, sometimes the lead investor in your last round. They put a lot of money into your business, and they can see the business going down in value, and maybe needing management changes. Maybe there needs a change in the plan altogether. So the investor on paper has lost most of their money, and you now desperately need funds. And the question is, should the investor just cut the losses and run, or should they invest more? And what some investors will do is they'll say, yes, I will invest more, but I'll do it on a convertible note. And the convertible note, if you manage to do a new round in the next year or something like that, or before you run out of money, great, I'll get a 20% or 30% or whatever discount on your next round valuation. But if you don't do a round by the maturity date, or you're about to run out of money, my investment will convert at a 10,000 or 100,000 pound valuation. In other words, I'm going to own somewhere between 51% and 90% of the business. So the investor is making a huge gamble, but they may have a high chance of losing their investment. But if you don't meet the repayment terms, then essentially the investor now owns your business. And if they own your business, one of the first things they might do is get rid of you, because they want to do something differently. It may be nothing wrong with you, but something has to change, and maybe they want to change the founders. So for you, this is as a founder, this is a difficult thing to digest, because on the one hand, it's a chance to save the business, but by saving the business, you might be the one thrown off the boat. And does this square with your goals? Rufus, thoughts on this?
I think one of the the things that I would like to put out there is that if you are a founder in this situation, it's often a lonely place to be, and the phone is not often ringing off the hook with people offering to help. And the point is that you need to start talking to people that you trust sooner rather than later, and try to figure out a way forward. And this chat today is just about trying to figure out what the options are. Nobody starts a business thinking about the worst case scenarios, but as you move forward, you've got to be realistic about saving your business and how best to do that. And these are kind of the tools in place. But then there's also the other dynamic, which is that often the professional investors, like the VCs, they have their own hat that they're wearing. And so it may well be that some kind of significant down round is the right thing that you think you should do, but they don't want to mark it down because they might be in a marketing period for raising their next fund, and they don't want to show that. And so there's all these different things at play. And often when you go into when you take money from people, you don't read the small print on the term sheet. That's another thing that's kind of quite important. Nobody wants to be in this situation, but you've got to try to figure out the best way forward when you are, and do the best by everybody. Help your investors that don't want to be there to move on. Raise the money you need to give the company the best chance. And one of the other things we haven't mentioned is that obviously if you have supportive investors that are willing to back you in whatever down round you're doing, the way for you to then re-up your own position if you can't afford to participate in the round, which as a founder on lowly salaries you often can't, is to reset the option pool. And again, that's another thing that obviously you need to speak to your lawyers about, SeedLegals or whoever, because but it's likely that they will be set against milestones from this point, rather than just an option pool for management. This would be properly sort of dug into by the investors to make sure that it's that they think it's fair.
So that's a great point. So two things. Firstly, if you're watching this and you're faced with a down round, you can console yourself that you're not alone. And at SeedLegals, I get calls from many founders that are struggling to raise. They may need to shut down the business. They're looking to sell the business. They may need to do a down round. So it's by no means unique. And if that is any help. So the next thing is the founder shareholding, which is a great point that you've raised. So let's say you've done a couple of rounds so far. The founders, let's say, collectively have got 60% shareholding, and now you've got a down round that is going to give the investors, 50% equity, and at the end of this, you'll have 30% equity. Let's say the two founders, so you've got 15% each. The investors might be worried that you've got sufficiently little equity, that you're not motivated, and maybe future investors won't come in because they see the founders have got too little equity. So the existing shareholders, which is existing investors and the founders, have been not quite wiped out, but substantially diluted in this down round. But the investors, of course, want the founders to be all in. So what can they do to help with more equity? Well, just giving you more equity equity is essentially diluting themselves. So they're just not going to do that. So there are two things that they can, and by the way, giving you more equity, giving you free shares means tax liabilities for you, because if you're getting £1 million of shares for free, now you've got yourself £1 million tax liability. And if you're an employee of the company is a PAYE liability, so you just can't give founders more shares for free. So there are two things you can do, or that you can agree with your investors. One is you can have an option pool, and you can give the founders more options, potentially even EMI options if they've got little equity. So it comes from the option pool. And the investors are unlikely to go, hey guys, here's a bunch of options. They're more likely, as Rufus says, to tie it to performance things. So if the company gets to this, revenue, or you reduce burn rate or something, you get more options, and you can exercise these options later on an exit. So with options, good news is it's a way to give you a path to topping up. Bad news is share options, until you've exercised them, don't have voting rights. So you're still, as founders, going to have potentially less than 50% voting rights, which means the investors are controlling the company, but it is what it is. The alternative is growth shares. So what are growth shares? Growth shares are like regular shares, except they've got what's called a hurdle. And a hurdle says, let's say I give you shares today, and the price per share today is £3 a share. And I give you growth shares with a hurdle of £3 a share. This means when you sell your growth shares, the first hurdle goes back to the company, and you keep the amount above the hurdle. This means if you sell the shares at today's valuation, they're worth zero, because the money goes back to the company. It only has value if the share price goes up. And because the value is zero today, it means there's no tax liability today. It also means that, of course, you only get any value if the valuation goes up. So what you might agree with investors is you get allocated growth shares. Growth shares, you could set them up to voting or no voting rights, but hopefully with voting rights, and now you've got more votes and you're back in the game again as even potentially majority voting rights. But of course, the value for these growth shares only happens if the valuation goes up, and the investors may still put vesting against it. So you only get some of these growth shares allocated when you hit performance targets. So knowing these two vehicles is something some astute investors might propose, but it's also something that you can propose. And of course, whether it be the share options or the growth shares, you can do these both on SeedLegals, and we can help guide on those. And by the way, the thing with growth shares is you need to set a hurdle. If the hurdle is too high, then, let's say your share price today is £3 a share, and you say my growth shares have a hurdle of £20, your company has to be like 7x the value before there's anything in the value of those growth shares. Set the hurdle too low, and you start having tax liabilities on it. So you really want to use an accountant to justify the growth share valuation. Rufus, over to you.
Yeah, no, I was just going to ask, because I don't know the answer, and I'm really interested. Can you set the growth share hurdle at, let's say you raise money at £3 a share last, like EMI options, can you set the hurdle without triggering a tax at an EMI valuation which is lower?
That is a great question, and the answer is no. And here's why. Because when you do an EMI valuation, so if you give share options to employees, there will be EMI options. And what you do is you agree with HMRC an EMI valuation. And your goal is to make this valuation as low as possible. So what you do is you get on SeedLegals, for example, and we'll help you create that valuation. And we'll use a wide range of arguments to show the company's losing money. It's the next round will be lower. We're going to run out of money. The shares that the employees will get have got no voting rights or no dividend rights, and they don't have EIS things, so they're less valuable to investors. So we create a range of arguments to say to HMRC, the valuation for the EMI options should be maybe a 70% discount to the value that the investors have paid. But when it comes to growth shares, HMRC doesn't do these agreed values. And instead, they want you to come up with a value. And then one day later, they will have a view whether this value was taxable or not, which means that when it comes to the EMI valuations, you want to be as aggressive as you can, because if it doesn't work, HMRC just write back and go, no, we don't agree to a 70% discount. We'll agree to a 35% discount. And you can go backwards and forwards and argue the toss, but ultimately you settle on a value. It may not be as much as you wanted, but you're going to settle on it, and there's going to be no tax liability robustly. Whereas with growth shares, pick a value one day that HMRC will challenge, and then they'll go, oh, you now owe us a whole bunch of money. So you can't be aggressive in picking a low growth share valuation, and therefore it's the common wisdom is the growth share valuation will be your last price per share plus 10 or 20%, so that there's just no chance that it's deemed to be in the money, so to speak, and taxable.
Makes sense.
All right. So let's jump possibly finally here to SEIS, EIS loss relief on a sale of the company, on a shutting down of the company, and potentially a sale of shares through, for example, Plan D. So Rufus, take us through the different scenarios there.
So, I mean, effectively, one of the other things that you didn't mention to throw into the mix is negligible value claims, because that's something that people should understand. And one very quick tip that I think that all investors should do, and I actually think most of the people here are going to be founders. But when a Companies House have a very good tool where you can register, and anytime a filing is made, then you get notified. And as an investor, if a company goes into administration, which can happen, I've spoken to investors that didn't know that the company that they hadn't heard from in a couple of years had actually gone under, and they had significant tax breaks that they could claim legitimately, but they had no idea. And sadly, when things aren't going according to plan, often founders are just not talking to their investors. So they might know it was going badly, but just not understood it. The reason I'm sort of focusing on negligible value claims is also because it's something that's widely misunderstood, and also has been widely abused in the market over the years. You can just tick a box in your self-assessment and say, I've written those off, and you make a claim to zero, even though you still own those shares. That's a tool at your disposal. But obviously, if you do get challenged by HMRC, and you're in the example we gave before of your 10 grand investment that's down by 95%, if the shares are genuinely worth 500 quid, then HMRC don't want to give you a write-off to zero, because the shares are genuinely worth 500 quid. And we've seen pushback on some advanced clearance that some big angel groups that we've worked with have actually gone to HMRC on things that are down even more than 95%. And they've said, no, that is not what a negligible value claim is. It's for when a company has genuinely gone bust, or you can demonstrate that it's worth zero and has no future prospects. And then obviously, the other ways of getting your loss relief is obviously if you can sell your shares, that's where Plan D comes in, or if the company gets bought. And obviously, as to what value the company gets bought at compared to where you invested is how much you're able to claim. Obviously, if you invested if you invested 10 grand and you get 5 grand back, then obviously you're getting less tax relief than if it went bust completely.
Okay, so I think if you've got SEIS or EIS investors, explaining the loss relief and helping them get the loss relief is a huge mitigation, right? So if if they've claimed their initial tax deduction on SEIS and they're getting loss relief at the end of it, it's like 75% or more of their money that essentially they're getting back. So this can turn a really bad situation for them into, okay, stuff happens. So let's just spend a moment more on this loss relief. So the less good period for an investor is they put their money into the business and they've taken 50% tax deduction from their SEIS. And now the company's not performing, and it's what could be called zombie mode. It's not a nice word, but essentially it's lost all value. It's just trundling along. But the investor hasn't been able to claim their loss relief. And so what you want to do is you want to help the investor claim their loss relief and maybe get them to do something for you at the same time. So they can claim the loss relief if you shut down the company, even if it's within 3 years. You can claim the loss. They can claim the loss relief if, as Rufus pointed out, they can prove that the shares have got no value, as opposed to it looks like the company's not doing anything. I reckon they've got no value, but HMRC might not agree with that. So how can you prove they've got no value? Well, obviously the company shutting down, and you could do that if you owe money, then it's a forced involuntary liquidation, which you want to avoid. If you don't owe anyone any money, it could be a voluntary liquidation. And if you don't owe anybody any money, you can just shut it down on company's house. You don't need a liquidator. And then it's obvious that the shares now have no value. So ironically, for investors, you shutting down the company is often better than leaving the company going. So, but if you want to leave the company going and not shut it down, you still want to help them get their loss relief. So one way of doing that is you could buy their shares from them potentially, but they might think of this badly, which is, you're game playing here. Sorry, I invested at a 5 mil, and now you want to get my shares and buy them yourself at a tiny valuation, and you put me out of everything, and you're gaining from this. So perhaps the Plan D approach, which is, we're going to help you get your loss relief. You're going to sell your shares. You're essentially going to lose money on it. You're going to get your loss relief, and you're going to get shares in this fund, which hopefully will have some upside later. Thoughts, Rufus?
Yeah, so I mean, in the past, some people have just said, I've had enough, and sell their shares back to the founder for £1. But we've seen, for the reasons I gave before, a lot of industry players, including accountants and VCs, saying that is not reasonable in the eyes of HMRC, because if the shares are worth £500 and you're clearly selling for £1 just to take your losses, you're effectively gaming the system to maximize the tax loss. Also, I mean, if you sell it for fair value, obviously Plan D, we've built the structure so that it's an arm's length transaction between unconnected parties at a price that genuinely represents fair value. We've got a third party fund manager that sits above the fund. We just introduced deals. If £500 is fair value, clearly that could go to zero, but it could also maybe, 2 or 3x or 5x or whatever. It may be unlikely to get back to where you originally invested, but it still could go up from £500, but you've had enough of it. You take your losses today and you take a ride on the fund. And irrespective of whether the company you swapped in goes to zero or does well, you benefit from any liquidity events that happen within the fund. And the key is that the fund is buying your shares for fair value today. So there can be no arguments.
Right. So we've got a really interesting question in the chat, thank you, which is that if an investor has the opportunity to invest in a down round further and with their pro rata or preemption right and doesn't take up that right, do they lose it? And it's a great question. So pro rata rights are probably more of an American terminology. It says maybe when you've done a SAFE or a seed fast, it says in the next round, you have the right to do X. So a pro rata right just in that terminology might exist just for a particular round. But otherwise, if it's your general UK company law preemption rights, it always exists. So an investor can be given a preemption right in your next round. And if they don't take that up, then they stay with whatever now diluted equity. And then when you do your next round, they still have a preemption right in the next round. So preemption rights are always there. Pro rata rights, you would want to look to see what the definition of the pro rata right is, because it's not just a defined term. It's something that you would have given to the investor as part of some previous investor agreement, and then you would look at the terms of that to see. So, Rufus, were there any things that you'd like us to cover? Any remaining things before we wrap up?
I think one of the other comments brings it back to our down rounds a new bridge. One of the questions addresses that, just to bring it back to the title. And obviously, a bridge is a bridge. It has to be a bridge to somewhere. To John C's point, if there's clearly something within 3 months time horizon that you need to fund the company to, but of course sometimes that does happen. But in in most instances, I think that the bridge to 3 months to that big contract does more often than not doesn't happen. Everything takes longer than you expect, and I think that most of the down rounds that we're seeing are actually giving proper runway, albeit often on a significantly reduced cost base. So you're having to completely reforecast the business. But I think that it's important that as with most funding rounds, you need to give the company proper sort of runway to get to the new inflection point.
Okay. So just before we wrap, when we were talking ahead of the call, you were saying that one of the issues that founders see is, let's say you're looking to do your next round at a 10 mil valuation and you're just not getting a bite. And so from new investors, so you go to existing shareholders and you're not getting a bite. So then you go back to them and say, all right, 8 million valuation, and you're not getting a bite. Your thinking is that you may have burnt some bridges, so to speak, by trying to go for a slightly lower valuation, because the reason you weren't getting a bite wasn't the difference between 10 and 8. It was some fundamental thing that needs to change. And maybe you have to go in at a substantially different rebase thing completely. So obviously that's a big bet, because if you could raise at a slightly lower, why would you do that? Then it's say, okay, great, we'll raise at a 1 million. All right, we really need you to come in. This is your chance to, save your investment or not. Let me know your thoughts on that strategy of when you do a complete rebase, and what are the signals that might be something to do?
I think it's you've got to read the room, and it's often investor led. So you as a founder, you know what you want. In terms of you need to know how much you want and where it's going to take you every round and any round you do. But as to what people are willing to pay for it, that's where you're having the conversations with people. And that's why, coming back to the point I made at the beginning, I think that having open and regular dialogue with your investors makes sense, whether you're doing really well or really badly. And especially when things are not going according to plan, you're going to need to potentially do a down round. Speaking to those bigger investors that are supportive, that are likely to stand up and lead the round, they're the ones that are going to lead the pricing as well.
It's a great point, and maybe a good place to wrap up, which is, having bad news updates to your investors is never desirable. But I think if investors could see the rate at which things are progressing and see progress, you want them to buy into your plans, right? So plans weren't what you wanted and weren't what they wanted. But if you spring the surprise on them that you've been having upbeat messages and suddenly something's different, firstly, they're not going to trust you. And secondly, the time to pause why everything is different may lead to them not wanting in, whereas they can see it's not working. You're trying to get, thoughts and ideas and help. If you can bring them in to be part of wanting success, even if that means success is a different plan, then at least the common wisdom is that's the way to do it, even though that conversation is, not the one that you're looking forward to. All right. So, Rufus, where can people find you for more info?
Pland.co is our website, and happy to speak to any founder. Obviously, if you're talking about down rounds, it can be a sensitive conversation. So, we understand your pain, and this was very much founder-led building this. So, we're here to help.
All right. Thank you very much. And of course, for me, you'll find me Anthony Rose on LinkedIn, or Anthony@SeedLegals.com, or hit the SeedLegals web chat. And we, obviously, if your last round was on SeedLegals, we are there to help look at the deals, the terms in the articles and shareholders agreement to see what your rights are. And we can give thoughts on what your strategy might be. And if you want to reach out to me directly when things are going well, or when things are not going well, that's key to me, which is we're here for the good times and the less good times. We're always here to help you get to success. Thank you, everyone, for watching. Thank you so much, Rufus. Thanks all.
Bye-bye.